This quarter, the core macro narrative has undergone a fundamental shift. If you only looked at nominal GDP, you might be lulled into complacency. But as fiduciaries, we must focus on what really matters: real purchasing power. Our models now confirm that consumer purchasing power is undergoing a severe compression this year, worse than last. This isn't a gentle, cyclical slowdown. It's a full-blown deleveraging style squeeze. Why? Because the excess savings buffer, those pandemic-era deposits that shielded the U.S. economy from recession during this tightening cycle, has finally been exhausted. With that cushion gone, the previously hidden erosion of real incomes is now fully exposed. Every dollar of nominal income is being diluted, its purchasing power evaporating. Sticky inflation, the new structural reality. Today's inflation readings exhibit a suffocating stickiness. It's not just that inflation is high, it's that it's stuck. The data shows it's stubbornly clinging to 3%, refusing to return to the Fed's 2% target. To the untrained eye, a 1% gap may seem trivial, but in macroeconomics, that single percentage point is the divide between a soft landing and persistent stagflation. In a world of deglobalization, tariffs are no longer just negotiation tools, they're de facto inflation taxes. Our decomposition model reveals that tariff policies contribute roughly 0.5 percentage points of structural inflation to the CPI. This 0.5% isn't driven by demand or supply. It's imposed by decree. That makes it rigid, immune to monetary tightening. No matter how much the Fed hikes, the cost inflation from trade barriers remains. This is artificial, administrative supply-side shock, and it's now baked into the price floor of goods and services, forming a critical pillar of inflation's entrenched persistence. The great inflation rotation: goods deflation versus services stickiness. The durable goods sector is now in a textbook deflationary cycle. Consumer electronics, sportswear, apparel, non-essential goods are plagued by inventory glut from overpurchasing in the past 2 years. The classic bullwhip effect. To clear shelves, retailers are slashing prices. If you're buying a TV or a pair of sneakers this quarter, you're reaping a deflationary windfall. But that's only one side of the coin. In services, the story flips. While pricing power is weakening in hospitality, a natural hangover from the revenge travel surge, the money consumers save on hotel bills isn't being saved. Instead, it's being fully absorbed by the most ironic of ironies: sky-high airfares. Air travel is a textbook oligopoly with high fixed costs. With pilot shortages, volatile fuel costs, and delayed aircraft deliveries, supply capacity is nearly inelastic. So even as hotel prices soften, the total cost of a trip keeps rising. That's why you might feel some prices dropping, yet your overall cost of living remains stubbornly high. Inflation has rotated across sectors, but hasn't vanished. Our verdict: structural inflationary stickiness is here to stay. We are unequivocal and hawkish. Inflation will remain deeply sticky. Don't expect a smooth glide back to 2%. This isn't sentiment. It's anchored in 3 irreversible structural drivers. Labor market tightness at historic levels. The U.S. labor market remains exceptionally tight. The core mechanism of the wage price spiral, where rising wages feed into higher prices, which in turn demand higher wages, remains unbroken. As long as unemployment stays low, services inflation has a firm floor, easing financial conditions despite high nominal rates. A counterintuitive reality: real financial conditions are actually loose despite high nominal rates. Equity markets are rallying, credit spreads are narrowing. These factors offset the tightening effect of rate hikes. The Fed's balance sheet is still massive. Liquidity is still abundant. The restrictive stance is a mirage. The cost of geopolitical realignment. This is more than trade policy. It's the price of de-risking global supply chains. Onshoring, bringing production home, and friendshoring, shifting supply to allied nations, mean trading efficiency for security. That's inherently inflationary. We are exiting the Great Moderation, the era of low volatility, low inflation, and low interest rates, and entering a new era of high cost, high-friction globalization. Together, these three forces act like a fortified seawall. They will resist any near-term mean reversion in inflation. Institutional investors must recalibrate their models, discard the low inflation, low rates base case, embrace a new regime of high inflation volatility. The U.S. housing market, a frozen paradox of high prices and high rates. Now, let's turn to the largest asset class in the world, U.S. housing. Today's market exists in a rare, twisted equilibrium, what we call a liquidity freeze, high valuations coexisting with high rates. In a normal cycle, rising rates depress asset prices, but this time the logic breaks down. Consider the data. The 30-year mortgage rate is anchored near 6.4%. That's double the rate on the vast majority of existing mortgages. Even though swap markets are aggressively pricing in Fed rate cuts next year, that does nothing to alleviate the current pain. Most homeowners are trapped by the lock-in effect. If you have a 3% mortgage, why would you sell to take on a 6.4% loan? The math makes it irrational. Sellers disappear faster than buyers. This asymmetric imbalance, weak supply, weaker demand, creates artificial scarcity, propping up prices. This isn't market efficiency. It's market failure, a liquidity death spiral. Meanwhile, new supply can't respond. Tariffs have jacked up the cost of lumber, steel, and concrete, add labor shortages, and new construction is capped. Developers, facing high financing costs, are in retreat. They won't build because they can't profit. The result? A supply shock meets a demand freeze. Even with slowing price gains, U.S. home prices today are 16% above pre-pandemic trend lines, a massive premium. Now, look at the valuation fundamentals. The price-to-income ratio has now exceeded its 2005 peak, the height of the previous housing bubble. Remember what happened after 2005? I'm not saying a crash is imminent, but when prices are so detached from fundamentals, future returns will be slim or negative. This is a bubble built on the illusion of scarcity. The myth of rate cuts equals lower borrowing costs. Here's a widely held but deeply naive market myth. When the Fed cuts rates, borrowing costs fall. This linear thinking is dead wrong in today's complex financial system. We must correct the record. The actual cost of a mortgage or a corporate loan isn't set by the Fed's overnight rate. It's anchored to long-term rates, specifically the 10-year Treasury yield plus risk premium. Let's revisit history. Since the Fed began cutting rates last September, priced in market, what happened to 10-year yields? They rose a counterintuitive bear steepening. The Fed's power is overstated. They control only the short end of the curve, the overnight rate. But the long end, the true anchor of global asset pricing, reflects the market's decade-long expectations for inflation, sovereign debt, and growth. That's where the term premium lives. If the Fed pivots too fast, if Powell appears to surrender to growth concerns over inflation, the market will reprice central bank credibility. A loss of confidence triggers a bond vigilante response. Investors demand higher compensation to hold long-dated debt. This mechanism delivers a double whammy. 1. Long-term yields spike, raising borrowing costs for homes, corporations, and governments. 2. The dollar weakens, reigniting imported inflation. In other words, the Fed may cut, but real financing costs could rise. We may be entering the infamous pushing on a string phase where monetary policy loses traction entirely. The AI wealth effect and the K-shaped consumer. Since the Q4 2022 low, the S&P 500 has surged to 75%, while the Nasdaq has jumped nearly 120%. Such momentum is historically rare. This explosive asset inflation has created a powerful wealth effect for those who own assets. When your portfolio hits new highs every day, you spend more. That's fueled a classic K-shaped recovery. The top of the K asset holders. Their spending remains strong, supporting high-end services, luxury goods, and travel. The bottom of the K, wage earners. For low-income households, purchasing power has deteriorated since spring. Inflation eats wages, high rates crush credit cards. This wealth divergence makes interpreting macro data incredibly tricky. Averages mask deep structural fractures. We're now in a fragile moment. The market's entire bull run rests on one dominant narrative: AI. If that narrative cracks, say, if big tech capex fails to convert into real revenue growth, or if scaling laws hit a bottleneck, a systemic shock could unfold. The wealth effect is bidirectional. When asset prices crash, negative wealth effects freeze spending overnight. Note: even during recent relief rally pullbacks, high-end consumption has shown stunning resilience. That sounds good, but it's actually dangerous. It implies that to finally cool the overheated U.S. consumer and return inflation to target, we may need a longer, sharper capital reset, not a soft landing. We may need a real recession to purge excess liquidity and bad capital allocation. The rise of computation capital, the new infrastructure. Amid this macro chaos, one sector is defying gravity: data centers. These facilities combine complex network architectures, dense compute clusters, and mission-critical cooling, for example, liquid cooling. The logic is brutal. Without data centers, compute supply cannot meet AI's exponential demand. That's why, in a high-rate world, trillions are flooding into this sector. While traditional construction remains depressed, abandoned housing projects, vacant malls, data centers are one of the only alpha drivers. They are the sole bright spot in the fixed investment landscape. In contrast, the old economy is being abandoned. Office buildings and commercial real estate investments are weak not just cyclically, but structurally. Remote work and AI are permanently eroding the value of physical offices. Yet, capital expenditures are undergoing structural reallocation. This is creative destruction in action. The true growth isn't in bricks and mortar, it's in software and hardware infrastructure. Watch the hyperscalers' balance sheets. Their capital allocations to servers, GPUs, and AI architectures are now outpacing spending on physical buildings at an accelerating rate. This signals a profound shift in the engine of growth. We're no longer building economies by constructing more buildings. We're building them by stacking more compute power to raise total factor productivity. For investors, the lesson is clear: own the compute or the energy and infrastructure that powers it. Everything else is entering a long period of value reassessment.